Options trading is a lucrative yet risky way to make money from the stock market, but it can be confusing if you're not familiar with the terminology and concepts. In this video, I wanted to explain the basics of options and show you how you can start trading options today with real case examples. Trading options can be confusing, so don't worry if you didn't get it the first time. You probably won't get it the third time either. But with some patience and practice, you'll crack it and use it to your advantage. At the end of the video, you should have a basic understanding of what options are, how they work, and how you can make money trading options. For those of you who are new to the channel, welcome. My name is Neera and I'm a financial analyst. I talk about personal finance and investments and teach you how to make money and grow it exponentially. If you're interested in this topic, consider subscribing, as this will help the channel grow and impact more people. When it comes to the world of investing, there are a lot of options to choose from, depending on your risk tolerance, time horizon, and knowledge of the markets. Stock options, the focus of today's video, are higher on the risk level and require an extensive knowledge on the basics of the market, individual stock movements, and stock options mechanics. I will explain what an option is. Next, I will break down two types of options, calls and puts. Then I will go through practical ways you can make money with options. Finally, I will conclude with the benefits and risks of stock options. A fair warning, as I mentioned earlier, stock options are difficult to navigate at first. So be patient and stick to the end of the video to get a complete understanding before trading with options. Let's dive in. Stock options are contracts that give the holder the right, but not the obligation, to buy or sell shares of a stock at a set price within a certain time frame. Let's break it down. The first part simply tells you that you don't have to buy or sell the shares of the company. Instead, you buy into a contract that enables you either to buy or sell the shares if market conditions are favorable to your part of the contract. Next, the definition states that the contract will include the price and a deadline by which you will need to decide whether or not to execute the contract. I should mention that the right to buy or sell the shares depends on which contract you get into. We'll cover that later in the video. To elucidate options further, let's compare trading stock options with trading regular stocks. Let's say you think Microsoft stock will go up in price from its current price of $259. Obviously, you'll want to buy the stock, wait until the stock price increases, and hopefully sell it at a profit. If you're right and say in 2 years, Microsoft price increased to $312, you will make a profit of $53. On the other hand, if you get it wrong and Microsoft actually decreases in price to $209, you will have a loss of $50. In other words, your profit or loss changes exactly the same as the stock's performance. It is called a linear relationship. If the stock price increases by $1, your profit also increases by $1. The same logic applies when the stock falls by $1. You get the idea. In either case, you decide if you want to sell your shares or buy more and hold on to the company for as long as you'd like. Now, let's compare that with trading options. Using the same examples with Microsoft, if you think the stock will go up, you can buy options, in this case a call option, which will give you the right to buy the stock at a certain price called the strike price within a certain time period up to the expiration date. Unlike a stock purchase where you can choose how many stocks to buy and when, an option contract consists of 100 stocks per one contract and has a deadline. For instance, you bought a call option for $20 with a strike price of $259, which will expire in 60 days from today. Using the previous scenario, if Microsoft price increased to $310 within the 60-day period, you can execute the option and exercise your right to buy the stock at $259 and then sell it in open market for $312. Your total profit will be the $312, the price in the open market, minus $259, the price you paid for the stock as part of the contract, minus $20, the premium you paid to get into the contract, totaling $33. In the second scenario, if the stock went down to $209, you just simply don't exercise the option and let it expire, limiting your losses to $20. I will walk you through an actual option trade later in the video, so stay tuned till the end. Generally, options fall under two categories, a call option and a put option. A call option is a contract that gives the holder the right to buy shares of a stock at a set price within a certain time frame. Buying a call option is a bullish trade, meaning you're expecting the stock to rise and want to benefit from it. You can also sell a call option, in which case you're on the other side of the transaction where you receive the premium for the call option and will be obligated to sell the shares at the strike price if the buyer chooses to execute on the contract. In our previous example, as a call option seller, you will receive the $20 as a premium and promise to sell Microsoft stock at $259 strike price until the expiration date. If the stock goes up to $312, you lose $33, which is calculated as $312, the price at which you will have to buy the share on the open market, because you'll have to get the shares before selling it to the other party from somewhere, minus $259, the price you receive for the share per the contract, minus the $20 premium you received for entering the contract. In the second scenario, where the stock drops to $209, the buyer will not exercise the option, which will leave you with a $20 profit. Selling a call is a bearish trade and is used when you predict that the stock will fall in price. Next, let's break down put options. A put option is a contract that gives the holder the right to sell shares of a stock at a set price within a certain time frame. So unlike a call option, a buyer of a put option is bearish and predicts that the stock will go down in price and wants to profit from it. Let's use the same example to demonstrate. For instance, you bought a put option for Microsoft stock for $20 with a strike price of $259, which will expire in 60 days from today. If Microsoft stock price increased to $312 within the 60-day period, you will not exercise the option and let it expire, because it does not make sense to sell the share at $259 if you can sell it at $312 in an open market. Your losses are limited at $20, the premium you paid for the contract. In the second scenario, if the stock went down to $209, you would buy the stock in an open market for $209 and then execute the option and exercise your right to sell the stock at $259. Your total profit will be $30, which is calculated as $259, the price you sold the stock at as part of the contract, minus $209, the price that you bought the stock in an open market, minus $20, the premium you paid to get into the contract. On the other hand, if you want to sell put option, you collect the premium and promise to buy the stock at a strike price until the expiration date. So you will profit $20 if the Microsoft stock price increased in our example, and will lose $30 if the price decreased, because you have an obligation to buy the stock at $259, which is cheaper in an open market. It is a lot to comprehend, so don't feel pressured to get it all the first time. Feel free to pause the video, go through the examples again, and re-watch it as many times as you need. Options are a complicated trading strategy and will need some time to understand. If anyone is trying to oversimplify it, don't buy into it. They're probably making more money talking about it than actually trading them. So take your time and learn at your own pace. Now back to learning about options. Besides being opposite trades, one key difference in using calls versus puts is that a call buyer has unlimited gains, whereas a put buyer has limited gains. Reason is, with puts, you're betting on the price decline and prices just cannot drop below zero. In case of a call option, you're betting the stock price will increase, and theoretically, there is no upper limit to a stock's price. Therefore, the gains are theoretically unlimited. There are other option strategies like covered calls and puts, which decrease the risk inherent in options and trading overall. I will cover them in more details in another video, so make sure to subscribe to the channel and hit the notification bell to not miss out on that. Now let's look at an actual trade, which will hopefully make more sense. I'm going to demonstrate using Charles Schwab mobile app, and depending on which app you'll use, it will probably look a little different, but the idea and the terminology will be the same. I'm going to use my cell phone and include a screen recording over here so that you can follow along. Let's go ahead and open the app and look for ticker symbol MSFT. Next, choose Options Chain. This is a list of options you can trade. From the top, you can see the ticker symbol MSFT, and next you see 100, which is a standard number of share per one contract. Next, you can choose the duration of the contract and expiration date, ranging from 5 days all the way to 719 days. This is different depending on the availability of the option contracts for a particular stock. Usually, the more popular the stock is, the more options are there available for it. Let's, for instance, choose the 76 dates, a little over 2 months, to give the stock some time to make considerable move. After we choose the duration of the contract, we will see all the available contracts for that duration and their prices. This in the middle is the strike price at which the contract can be executed. In other words, that's the price that you purchase the right to either buy or sell within that expiration date. On the left side are all the calls, and on the right side are all the puts. Notice that the lower in the strike price you go, the higher the call options price. That's because there is less risk for you and more risk for the option seller. All right, now I want you to just ask yourself a simple question. Where do you think the stock will go from here? If the answer is it will go up, then you would want to get into a call option. Next question is, by how much do you think it will increase within the next 2 months? Let's say that it might increase, but since you don't know by how much and there's a time constraints and you just don't want to predict, let's choose the option at 260, which is approximately the same as today's price. For the options chain, the call option will cost $15.65 for the chosen strike price. Quick note here, the price is expressed at a per share basis. So if you want to get the total of how much you'll actually pay, you'll need to multiply that by 100 for each contract you intend to buy. So in this case, one contract will cost you $1,565. On the next screen, you'll see all the complicated stuff that gives you more information. However, don't overwhelm yourself with this for now. Just try to understand the basic mechanics. Now let's go ahead and hit trade. In this screen, you can see the Microsoft current price. Under symbol, it shows which contract you're about to trade. In our example, the contract expires at September 16, 2022. 77 days from now, and the strike price of 260, and the C at the end denotes a call option. You can click on it and change if you want to. Also, if you know what you're buying, just go straight to the trade tab, which will take you to the screen right away. But for me, I just want to see the chains options table to make a decision to compare different prices at different strike price. So it's just easier for me. Next, you'll choose an action from the drop-down menu. The options you are given are buy to open, buy to close, sell to open, and sell to close. Since we want to buy an option, we will choose buy to open. And open in this case just simply means you don't have an open position yet and you want to open a position. And buy to close is when you have a position and you want to close the position. But again, don't sweat it. Next, you'll need to choose the quantity. We will choose 1 in this case, which will give us the right to buy 100 shares up until the expiration date of September 16. The order type drop-down menu gives you options to choose from depending for how much you're willing to buy the option. For now, let's choose market, which will use the current ask price of the option. In our case, it is $15.65. Now, go to Trade Calculator to see your profit or loss at different prices. We can see from here that the break-even is at $275.65. It takes into account the premium that you paid initially. Anything above that price will give you a profit, and anything below that price will leave you at a loss equal to that premium that you paid initially. So therefore, when making a decision on the strike price to choose, keep that in mind. After you review the trade calculator and still think that that strike price was a good idea, go ahead and press review order. Here you'll go through the details once again to make sure that everything's correct and go ahead and place the order. Next, you'll just wait and see how the stock price moves, and if it increases above the break-even price of $275, you'll turn a profit by exercising it. If it drops, you'll let the contract expire and lose the premium that you paid for it. To summarize everything that I said above, there are 4 main ways to trade options. Buy a call option if you predict that the stock price will go up before a certain date, so you're purchasing the right to buy the stock and you pay the premium of the contract. Number 2, buy a put option if you predict that the stock price will go down before a certain date, so you're purchasing the right to sell the stock and you pay the premium. Number 3, sell a call option if you predict that the stock price will go down before a certain date. Since you're selling the contract, you collect the premium and you have the obligation to sell the stock if the buyer chooses to exercise the option. Number 4, sell put option if you predict that the price of the stock will go up before a certain date. Since you're selling the contract, you collect the premium and you have the obligation to buy the stock if the buyer of the option contract chooses to exercise the option. Finally, let's conclude with the advantages and disadvantages of stock options. Starting with the positive, options are a great way to expose your portfolio to huge upsides with smaller investments. When you buy an option, you only have to pay a premium, which is a fraction of the cost of buying the underlying asset. If the asset price goes up, you can make a profit that is way higher than your original investment. With a small premium for one contract, you get a right to buy into 100 stocks. And if market moves your way, you get to enjoy unlimited upside. Another benefit of options trading is that it can protect against a decline in the underlying asset's value. By buying a put option, for example, you can insure yourself against a drop in the asset price. This can be especially useful when you have invested heavily in an asset and are worried about a potential decline. But when it comes to investing in the stock market, there are a lot of things that can go wrong. The biggest risk of trading put and call options is that the markets can be very volatile. Prices can swing up and down very quickly, and if you're not paying close attention, you can make some costly mistakes. With options, you have to get both the direction right and the timing, which is very hard to do. And you may lose all of the money you invested when the investment does not pan out as expected. Stock options can be a great way to make money and protect your investment, but it's important to understand how they work and the risk associated with options before you get started. There are various strategies you can use to make money with options, which I will cover in a later video. For now, just try to understand the basics and get comfortable with the key terminology. If you like this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on notifications to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and I'll see you next time. Yay! Oh, I forgot. Oh, shoot. So the current so once we, as part of the contract, is it too hard to say? From stock will go down 312, where, no, let's dive in. No, let's dive in.